Hello, everyone, and welcome to today's webinar. My name is Joe Torrey. I'm the Bay Area-based investment counselor for RealWealth Network, and I'll be hosting today's webinar, which will be on some of the 1031 exchange questions we've been getting from you, our members, over the last couple of months. For those who are listening to a recording of this, this is being recorded on February the 1st, 2018. First, a couple of housekeeping items. Could you advance to the next slide? All right, this is our standard disclaimer. The strategies mentioned in the presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountants, tax advisor, and/or attorneys to discuss your specific situation. This is especially true for 1031s because there's so many things that are specific to each individual situation and state that you should really contact your attorney or CPA. This is more about houses. Past performance is no guarantee of future results, and real estate purchases are subject to investment risk, including the possible loss of amounts invested. While every effort is made to maintain an accurate and current information, the possibility of errors and updates always exists. So that's our standard disclaimer. Do your own due diligence. Learn what you can from today, but do your own due diligence and consult your professional advisors. So the agenda for today, we're going to first introduce our presenter, and then she's going to take us through a review of the fundamentals of 1031 exchanges and how they work, so we're all on the same page. And then we're going to look at special situations, specific questions that we've gotten from our members in the last few months, broken down into three categories relating to general questions, personal residences and entities, and then we'll open it up for Q&A at the end. So if you look at the upper right-hand corner of your monitor, there should be a rectangular orange-colored rectangle with an arrow. So if you click on that, there's a dialog box that comes up, and that's where you can type in your questions. And you can type them in as we go along, and then we'll try to get to as many of them as possible at the end. If your question is so technical and so specific to your situation, we may just have to get back to you after the call. But we'll try to get to as many as possible. Okay, our presenter is Dino Champagne. She's one of our two preferred 1031 qualified intermediaries at RealWealth Network. It's hard to believe, but she's done over 10,000 1031 exchanges, all kinds, the regular kind, reverse exchanges, construction, and she's done a lot of teaching, taught over 1,000 seminars, and is a frequent speaker at real estate and trade show associations. So she's very well qualified to speak on this topic. So Dino, just to start out with probably the most thought-provoking and intense question, how did you get a name like Dino Champagne?
Believe it or not, Joe, it is a very common question. For the folks listening on the call, actually that is my real name. It wasn't made up. I didn't change it for anything. I was given this name at birth. I ended up with the name of Dino because my mother and my uncle were 11 months apart. My sister and I are exactly 11 months apart. My mother is older. My uncle was younger. My sister is older. I am younger. My sister was named after my mother, so whether I was a boy or a girl, my name was going to be Dino because that is my uncle's name. So it has nothing to do with the purple dinosaur back in the Flintstone age. It's nothing to do with Dean Martin. While my mother may have loved him, that I didn't get my name after that. So, and then sometimes I'll run into situations because I'm, as you can tell by the name, half Italian because I'm the Dino part, the Italian Dino, and then Champagne is the French part. And so when I have Italian clients, they go, it should be Dina. And I go, I understand, but my mother wanted it unique, and so it's Dino. So that's how I got my name.
Wow, okay. So you've been in the 1031 business a long time, right?
Yes, about 16 years. I joined asset preservation in 2002. In my background prior to joining asset preservation, I was a commercial broker for approximately 14 years, and I also was a commercial banker for about 14 years. So my background is in banking, real estate, and 1031s.
Oh, well, okay. And how does your industry work? Are you guys regulated by the SEC or anybody like that?
Actually, no, we're not a regulated industry, definitely at the federal level. Certain states may have requirements for a qualified intermediary to do business in that state, but in general, we're not a regulated industry. So it's important when someone is choosing a qualified intermediary to facilitate their transaction that they're looking for the qualified intermediary's experience and the security behind that qualified intermediary. Asset preservation, we're owned by a large title company. Stewart Title is our parent company, and they've been around for over, I want to say, about 120 years. So we're backed by a large title company.
Okay, so you're kosher.
Yeah.
Okay. All right. Well, with that intro, why don't you advance to the next slide and take it away? Give us a review of the 1031 fundamentals.
Okay, very good. Just for the audience, I can speak on this topic for 8 hours, but I only have 60 minutes. So what we're gonna do is condense down and go through some of the basics of the 1031. When you have investment property, you're gonna find that this section of the tax code, because that's exactly what it is a section of the tax code 1031, is that as an investor, it gives you opportunities. And one of the most powerful things that you can deal with in a 1031 is, as an investment owner, when you go to sell the property, there's usually going to be some gain associated with that, hopefully. And we're going to talk about the tax rates in a minute. But it gives the investor an opportunity to basically to continue to reinvest into real estate. So we like to refer to that as our reinvestment plan. It's also a vehicle that can be used for estate planning. For example, you can diversify into many different categories of real estate, and maybe as somebody that's looking to give the property to their heirs, I might go and say, okay, I'm going to buy this property, this property, this property, and then when I go pass away, I may designate which one of my heirs is going to receive which property. The other beneficial to that is the fact that you get a step up in basis, which we'll cover a little bit later. So that's what a 1031 is. It's a very, very powerful tool so you can basically not have to pay the taxes, and you can use those funds to reinvest into another property. So when we talk about taxes in real estate, at the federal level, there are different tax rates. As an investor, when you own the property, you are depreciating the property. The purpose of depreciation is it lowers your real estate taxable income while you're operating the property. So for example, if I get $10,000 in rental income and my depreciation figure is, say, $5,000, then forget and I'm not going to go into detail on a full Schedule E, but if there was no other expenses on that property, then I would be reporting $5,000 worth of income as opposed to the $10,000 that I actually received. So it's a very powerful tool for cash flow. But when you go to sell the property, you have a recapture rate. So the federal government is going to come back and they say, okay, you depreciated your property by X number of dollars, so therefore you're going to have to pay 25% on the dollar amount that you've depreciated. So for example, if my depreciation was $100,000, then my tax liability with the depreciation is going to be $25,000. So that's what's called the depreciation recapture rate. So that's the first rate that comes out. At the federal level, there are two different rates for capital gains. There's 15% and then there's 20%. The 20% capital gain rate kicks in when an investor, if they're single, if their income is more than $400,000, if it's a married couple filing joint and their income is more than $450,000, you'll be taxed at 20%. Anything below that, you're going to be under the federal capital gain rate of 15%. There is another tax called the net investment income tax. Most people they don't know what that is. If you've heard of the term, the Affordable Care Act or Obamacare, that's what that rate is tied to. When you have income of more than $200,000 as a single taxpayer, $250,000 as a married couple filing joint, then you're going to be subject to an additional 3.8%. Now, keep in mind what I've said so far is taxes only at the federal level. So you have recapture of depreciation tax, 25%, long-term capital gain rate tax, 15 or 20%, and then potentially the net investment income tax of an additional 3.8%. For those that are in states like California or any state that has income tax, there's a few that don't, but there's most that do. You're going to also be subject to whatever that state tax is. For example, California's tax rates range from 9.3 to as high as 13.3. So when investors are selling a property and they're looking at just selling it and what would they pay in taxes, these are the tax rates that they're going to be subject to in the event that they don't want to do an exchange. So that's why we call this the power of exchange, because you have an opportunity, instead of giving 35, 30, or 40% of your cash or your profits to the federal government and your state government, you can take that money and you can use that to buy more real property. And that's, again, the power of the exchange. Now, when you're doing an exchange, there are pros and cons to any transaction. So let's talk about what are the pros to doing an exchange, and then I'll cover a little bit what the cons of doing an exchange. So the advantages of doing an exchange would be the tax deferment. As I mentioned, we have the depreciation recapture, federal and state taxes, and net investment income tax. You get to defer those taxes when you do a 1031 tax deferred exchange. The other advantage of doing an exchange is wealth accumulation. You get to preserve equity. And what we mean by that in this part of the slide is that instead of the cash coming out of my transaction, being given to the government to pay the taxes, I get to preserve that cash and use that to build my wealth. So I'm going to buy more. I'm continuing, if you will, my ownership into another property. Then there's leverage, which is an advantage. For those individuals that may be coming out of a transaction where they have a small loan on the property, they may want to go out and buy a larger property and use leverage so they can get that higher dollar valued property. Now, obviously, you're going to look into cash flow and all these other items when you're making these decisions, but it is an opportunity. If you have a lot of cash to put down and you can get more leverage, you're going to have the ability to buy a higher valued property. And needless to say, when appreciation is going on a higher number, it's going to be more than if it's going on a lower number. And then the other would be, sometimes individuals, they want to get some cash out of the property. Well, when you do an exchange, any cash you touch will be taxed. But you have an opportunity, once you do an exchange, if you refinance the property after the exchange is, I like to call it old and cold, so your exchange is totally complete, and at the advice of your tax advisor, you could potentially refinance that property and pull the cash out that way without having any tax implications at that point. The other item for the pros for an exchange is diversification. In the 1031 company, we're seeing right now a lot of diversification for the location of the property, as well as the type of property that people are exchanging from. So when we get into property, we'll cover a little bit about like kind in a minute, but I can sell here, for example, in California, and I might buy into another state like Florida or Texas or Ohio, where I'm spreading it around throughout the United States. So I'm diversifying by city, by state. I can also go from raw land. So if I own raw land, for example, and I wanted to buy income producing, that would be asset classification for diversifying. So I'm diversifying by asset class as well. And then the long-term ownership is the fact that depending on, you might get into a product which is called a Delaware statutory trust. If you're tired of dealing with the management or dealing with property managers, then maybe you get into another product type, I should say, which is a Delaware statutory trust where you have management relief. So that's, you still have your continuation of ownership, you're still deferring tax, but you don't have the management. And as I mentioned earlier a couple of slides ago, it's estate planning, because as an investor, I can continue to exchange, and then when I pass, my heirs can inherit the property. And when they inherit the property, they'll inherit it at a step up in basis. And what that basically means is that the current market value of the property at the time of my passing will be their new value to the property. Any gain, any tax on any gain that I've had over the time I've been doing exchanges is forgiven to the heirs. So some folks may use this as an estate planning tool. So those are some of the pros to doing an exchange. So let's cover what the negatives are to doing an exchange, or the cons. Well, first of all, when you do an exchange, there are specific rules that the IRS has set forth. under the Treasury regulations. And these rules are restricted by the investment dollar amounts as well as the time restrictions. So they're very, very specific. And we're going to go through what those rules are, a little bit later in the slides. Another downside, if you will, to an exchange is that you do not get a brand new basis in the property. So let me just explain that for those that may not be familiar with the term. When I buy a piece of property brand new, so I go out and Joe shows me a piece of property, I'm buying this property, that's my basis in the property, whatever I paid for that property. Okay, I don't take over the old owner's basis, I have my brand new basis. But when I do an exchange, and I exchange from my old property to my new property, I don't get that brand new basis like when I bought the property originally. My basis is reduced by my gain deferred. So again, this is a tax deferral mechanism. So that's one of the downsides to the exchange is I don't get a brand new basis in the property. Therefore, I don't get a brand new depreciation. It's all carried forward with me to the next property. There's ways of increasing that basis, and that would be by buying property a lot larger than what I sold my property for. The other component to the con, if you will, to the exchange would be the fact of lack of liquidity. Because in an exchange, I cannot touch my money. I can't use any of the money for my personal use without it being taxed. So my money has to flow to the next property. That's why you have, when you're doing an exchange, that's why you have the ability to defer the tax, because you're reinvesting that money into the next property. It's going into the next property. And very important when you're doing an exchange or considering an exchange is that before you make the decision to do one, that you consult your tax advisor. Because when you do an exchange, if you have not consulted your tax advisor and you actually had some losses on your tax returns that you could have used against the gain, you can't recognize it on that transaction. So very important to discuss these situations with your tax advisor prior to proceeding. Then the next thing is the possible risk for higher taxes. Now, I know we just had Tax Reform Act passed in the end of December last year. It rolls out into this year. Capital gain rates has not been touched, so those rates are remaining the same, but nothing's guaranteed. So you never know when you decide to sell the property what the tax rates are going to be at that time. So that is one of the risks of, and the cons, if you will, of doing an exchange. And again, as I've said a few times now, a 1031 is a tax deferral mechanism. It is not a tax-free mechanism, okay? I'm merely deferring the tax. At any time in the transaction or any time that I'm operating the property and I want to sell it, I can choose to pay the taxes, okay? So at any time, because it's tax deferral, all right? So just keep that in mind, not tax-free like your primary residence. Different set of rules and different tax code. Now, let's talk about these specific guidelines and rules that you have to follow when you're doing an exchange. Here are a few of the basics. What's the property qualifications? And we'll go into that in a minute. What are the timelines? What's the tax deferral requirements? What are the timelines? And then the identification rules. So once you get into a 1031, I like to express the fact that while you are in a real estate transaction, when you deal with a 1031, you are now in a tax transaction that involves real estate. And the guidelines in order for you to defer the tax are set forth by the Treasury regulations. So let's just take the first one. Let's deal with the property qualifications. When you're dealing with an exchange, the property that you are going to be exchanging is property that's held for trade or business or for investment. So if you're in a single family home and it's your primary residence, that is not a 1031. It has to be investment property or property that you're operating your business out of, okay, to qualify for a 1031. The next requirement is that the property that you're exchanging into must be like-kind property. In this situation, there's still a lot of confusion out there that like-kind is very specific. So if I'm selling a single-family rental, then I must buy a single-family rental in order to qualify with the term like-kind. And that's not the case. I can go from a single family rental to a single tenant triple net Taco Bell. I can go from raw land that I've held for investment for an apartment building. I can go from an apartment building to an industrial building. So it's very simple if you look at it this way. Investment real estate, you must purchase investment real estate. So investment real estate for investment real estate. That's the key to the 1031. That's what's meant by like kind. Now, some of the questions that might come up, can I exchange from the United States and go buy property in Canada or Mexico or Costa Rica or Australia? And the answer to that is no. It's like kind for the, it must be United States property for United States property, foreign for foreign. And that gets a whole nother conversation totally offline, okay? But it's U.S. for U.S. So I cannot exchange foreign real estate for U.S. real estate and defer tax, nor can I exchange U.S. real estate for foreign real estate and defer tax. Now, another component which comes up often is, what if I buy a property and I fix it up and I want to flip it? That technically does not qualify because the taxpayer's intent is not to hold the property for any period of time. While the party that's doing the fixing and flipping may view the property as an investment, the IRS does not view it the same way. It's viewed as dealer property. And dealer property is considered inventory, therefore inventory does not qualify as like kind in a 1031. Because the code says that you have to hold it for a particular period. It must be that you must intend to operate it as an investment property. So dealer property, quick flips, technically do not qualify for like kind. So it gets down to what was the taxpayer's intent at the time that they acquired the property, okay? So those are some of the property qualification guidelines. The next tax deferral key is that in order to defer the tax, you have to buy property, and when we're trying to do a full tax deferral, you need to buy property that's equal to or greater than your net sale price. You must reinvest all of the cash, and if you have an existing loan, that loan needs to be replaced, either through cash from outside of the exchange or through getting another loan on the replacement property. So purchase price for the replacement property needs to be equal to or greater than your net sale price, and you must spend all of the cash. So here's an example. If I have a sales price of $1 million and my closing costs, title, escrow, commissions, transfer tax, come to, say, $100,000, that means my net sale price is $900,000 in this transaction. If the loan that I have on the property right now is $500,000, that means that I will be getting $400,000 of cash, or I should say the accommodator will be getting near $400,000 of cash. So that means that I have to take the $400,000, put that down on the next property or properties, because you can buy multiple properties in an exchange, and I must get a loan of $500,000 or more, or at least buy property of $900,000 or more. So that is one of the requirements, is that you must spend all of the cash, replace any existing debt, buy property equal to or greater than your net sale price when it comes to doing an exchange. Can you do a partial exchange or buy down in value? And the answer to that is yes, and it will not invalidate your entire exchange. So in the prior example, if I'm looking at a sale price, my net sale price of $900,000, and I decide to only buy something for $800,000, then what that means is that I have what's called taxable boot. So if you ever hear an accommodator talk about, oh, that's going to be this much dollars in boot, it means taxable. That's our lingo for taxable. So in the situation where you have $100,000, you could be potentially subject to about $33,000 in taxes by not reinvesting that money into the next property. There are different ways you might benefit from taking some boot. Again, that's where your accountant would come in and you would have these discussions about potential losses that you might have. So as you can see, your accountant's going to be a very, very important part of your discussion. So hopefully that your accountant understands 1031s and feels comfortable guiding you through the particular process. Now, let's go to the guidelines and the timeframes. But when I take you through the timeframes, let me just step back a little bit and explain how we get to this timeframe. One of the components in the exchange in order for the taxpayer to defer the tax is they must have a qualified intermediary and accommodator. That's my role in the transaction. The qualified intermediary, what they do is we step into your shoes as the seller of the property. So you have to set up an exchange prior to the closing of your sale property, because the exchange documents must be drawn and signed prior to the closing of the sale property. If you close on that property and you do not have a qualified intermediary, you have a taxable event. So we are very, very critical to the exchange success in that regard. We're like the duct tape or the linchpin that keeps it all together with our exchange documents. Because the qualified intermediaries exchange documents restricts you from touching your funds because that's required. We tell the escrow company to deed the property directly to the buyer. So in effect, the exchange is taking place between the qualified intermediary, the accommodator, and the taxpayer doing the exchange. Now, you've got all of that in place, so you've done your due diligence, your homework, you've talked to your tax advisor says, yes, go ahead, do an exchange. You talk to the qualified intermediary, you get the exchange set up, the documents are drawn, escrow closes. This is when the time frame for the exchange will officially begin. At the close of escrow, day 0, you have 45 days, calendar days, in which to identify any property or properties that you would like to acquire in the exchange. After the 45 days, you have an additional 135 days to complete your exchange. So from beginning to end, your exchange must be done by 180 calendar days from the date of your closing on your sale. Very strict timelines. And I notice the words I said, calendar days, not business days. And you'll never hear me say 6 months, because 6 months could take you out to 181, 182 days, given the cycle of the calendar. So very important, 180 calendar days to complete your exchange. The first 45 days is your identification period. And I have to tell you, in my industry, that is the hardest part to the exchange, especially right now in low inventory markets. So if you're going to be considering an exchange, for those of you that already have investment property and you're considering putting it on the market and you're talking to your real estate agent and such about selling the property, that's probably a good time to start looking to see where you might want to reinvest and seeing what's available in those marketplaces. And I'm sure Joe will be more than happy to help you with all of that. Okay, so you want to just make sure that you're having those discussions very early on, because you can only buy what's on that identification list. Now let's talk about the identification rules. I'm going to cover 2, there are actually 3, but the 2 rules are the most commonly used. The first one is definitely the most commonly used rule, and that's where you can identify up to 3 properties. So you're physically restricted to 3 addresses. They can be for any dollar amount you want, but they're physically 3 addresses. That's the max in which you can identify under the 3 property rule. You can buy 1, you can buy 2, or you can buy all 3. Okay, but you're physically limited to 3 addresses. Now, sometimes what we'll see is somebody selling, for example, in California, which is typically a high valued area, and they want to buy in an area where the price point is a lot lower. They may be able to qualify for the second rule, which is the 200% rule. The 200% rule allows you to identify 4 or more properties. However, when you add up the fair market value of the say 4, 5, 6, 7, 10 properties, it cannot exceed 200% of your sale price. So for example, if I sold a property for $1 million and I wanted to identify 30 properties, when I add up the fair market value of those 30 properties, it cannot exceed $2 million. And then I can buy whatever combination I need to meet my exchange value, say, of $1 million. So we'll see the 200% rule used when people are selling from high-valued areas and buying smaller valued properties. They have an opportunity to use the 200% rule, and then they can pick and choose which ones are the properties that they're going to acquire. I had a transaction that somebody sold for about $1.4 million, and they identified about 40 different properties. And what they ended up doing was, I think they ended up buying about 20 of those properties. They were diversifying their portfolio geographically. They were buying a bunch of single-family homes throughout the Southeast and the Midwest area, okay? So that's what they ended up doing. They also used that particular transaction as a potential scenario that when they wanted to start selling off, they weren't going to be hit with the gain for the entire sale as that they bought for one property. So they'll have incremental tax hit as opposed to if I buy one property and decide to sell and not exchange, pay all the tax at one time. So everybody has their own little strategy about how they wish to do things. Now, there is a third rule, which we don't have a slide for, but that rule is the 95% rule. The 95% rule allows the taxpayer to identify unlimited number of properties, unlimited dollar amount. And you're going, well, why isn't that the first and only slide on there? Because you have to buy 95% of the total value of the properties you've identified. So basically, you have to buy your entire list. So when you're dealing in the 1031 arena, you want to be very careful about which rule you're going to be using and make sure that you don't step into something that could end up destroying your exchange as opposed to making your exchange very successful. I have to tell you the most commonly used rule that we see is going to be the 3-property rule. Pretty much I can determine by where you're selling and where you want to buy what your options for which identifying rule may be beneficial for you. Okay, so those are the specific, so these are the basics of a 1031. There's a lot more that goes into a 1031 transaction, but these are just merely the beginning guidelines of how this process flows. Now, we're going to cover a couple of specific situations. These were some questions that were posed to Joe and for us to talk about in this particular presentation. So the question was, if I'm selling my rental property in a 1031 exchange, can I buy a vacant home, or does it have to be already rented or tenanted? So the answer to that is yes, you can buy a vacant home from a 1031 perspective. Most of the time, that's how they usually go, at least in my experience it has been. I mean, unless you're buying an apartment building where the tenants are already there. But if you're buying a single family rental, you may not be getting that particular property with the tenant involved. So yes, you can go ahead and buy a property that does not have a tenant already. It doesn't have to have a tenant in place. All right, so that's pretty straightforward there. The next question is, I have a rental property I can sell for profit. Okay, can I 1031 even though I've owned it for less than a year? That has to be one of the most asked questions in a 1031. It comes in all forms, but the basic question is, how long do I have to hold the property for it to be declared held for investment or to qualify for a 1031? Well, here's the candid truth. There's nothing in the tax code that mandates a specific holding period. In a sense, that's a good thing because it's not saying you must own this property before you can do a 1031 for 2 years. Okay, so that's the good side of that. However, the taxpayer that's doing the exchange must be able to substantiate that the property they acquired and now wishing to sell, and especially if it's under a year, if they want to do an exchange, that the intention truly was to hold the property for investment purposes. And this is where having the discussion with whoever does your taxes is so important, because your tax advisor has to give you the guidance as to whether that party feels that you have held the property long enough for it to qualify for investment purposes in the event that they ever had to defend the transaction in an audit. So it's not a yes or no. It's not a 1 or 2 or 3. It basically gets down to what was your intent and can you support that intent? when you have short-term holds and you wish to do an exchange, okay? The next question, if I do an exchange, a 1031 exchange, and die, will my heirs have to pay the taxes I avoided paying? Under the current tax code, as I mentioned earlier, the heirs will receive a step-up in basis, which means that the value, that the basis that I had, if it would happen to be me that passed away, okay, if my basis in the property, in my example here says $100,000, and if the market value for that property at the time of my passing is $300,000, and I have been doing exchanges all this time, my heirs are not going to be subject to my capital gain tax that I've deferred over the years. And this is under current tax law. So it's not going to be passed on to the heirs that they have to pay the taxes that I've been deferring. Okay? So just keep that in mind. So right now, this is how it is under the current tax law. So no, the heirs will not have to be paying my capital gains that I've deferred if my heirs get when they inherit the property. All right, the next question. How will the President's tax overhaul affect 1031 exchanges? That's an excellent question. And just to give a little bit of a backdrop on how this question actually is an important one, is for the last 2.5 years, the qualified intermediary industry has been basically being a proponent of making sure 1031s were kept, because 1031s initially were on the target for being eliminated. So as an industry, we spent a lot of time going out there, and I say we, not me, but the folks in our industry, going out there and explaining to Congress the importance of maintaining this tax code. And fortunately, when the bill came out, 1031s for real property were maintained. So under the President's new tax law, the Tax Cuts and Jobs Act, 1031s for real property are still solid. They're good. So basically, it's business as usual. The one thing for 1031s that did get eliminated was personal property exchanges. And those would be exchanges like for equipment or airplanes that are used for a business purpose, arts and collectibles. They no longer have the option to do a 1031. But for real property and for most investors in real property, everything is status quo. Everything is good. And as I mentioned in the beginning, there was no changes to the tax rates. So none of the capital gain tax rates or the net investment income tax didn't get eliminated, or they didn't reduce any of the rates for the recapture, the depreciation. That's also been maintained. So I guess you can say too bad on that one, but at least we still have a 1031. So that's the upside. So we're still here. We're still good. Exchange away. The next one, I have a duplex. I live in one and rent the other. Upon sale of the property, can I 1031 the total value, half, or none? Common question, because it does come up where folks might have a duplex or two on a lot or something of that nature where they're occupying one property as their primary residence, and then the other property is the other building or property is an investment property. So when it comes to these types of situations, the accountant is going to come in and they're going to allocate the value associated with the primary residence and the value associated with the investment property. Only the investment property portion will be able to do a 1031, because your primary residence is a different tax code. That's code 121, and it may not even be, it's more beneficial to use 121 because that's tax-free money if you met the requirements for living in the property at least 2 out of 5 years. So let's just touch on the primary residence tax code for a second. If I have a primary residence and I live in it 2 out of 5 years, when I go to sell that property, if I'm single, if my gain is under $500,000, not my sale price, but my gain, if my gain is under $250,000, then that means that $250,000 gain that I have is tax-free. If my gain is $300,000 and I'm single, then that means the $50,000 that is different, I will have to pay tax on that. I cannot defer tax on that excess of the $250,000 for a single taxpayer. For a married taxpayer, it's $500,000. So in these situations, there's going to be an allocation between what is the value of the rental property to the primary residence. And we look to the accountant to do that because it's not just because if I have a duplex, assuming it's 50-50, because one unit square footage may be larger than the other unit square footage. So again, it's going to get down to the accountant to allocate how that value is going to be assessed. Okay, so you would do partial 1031, partial 121 in this situation. Now, once I do a 1031 into like-kind rental property, at what point can I turn the rental property into a personal residence without paying taxes? That also is a very common question. Okay, I mentioned that when you do an exchange, the property that you're selling must be property held for investment purposes. It also has to match on the replacement property side. So the property that I'm acquiring also must be held for investment purposes. So the question is, how long do I have to hold this property to establish that investment intent? So we get back to that holding period question, which was a little bit earlier, before I can move into the property as my primary residence. Again, this is going to be something that is going to be viewed by your tax advisor as to when may be a good time to convert the property. Some tax advisors that are conservative might say at a minimum 2 years to establish the investment intent. So you'd rent it out for 2 years. Some tax advisors that may be a little bit more aggressive may say a year is sufficient. It's going to get to the tax advisor. Anything under a year could become a very big challenge if you're ever audited, because then did you really hold the property for investment purposes? And there are cases where people have moved into an investment property soon and their exchange has failed. Okay, so you have to be careful as to when you convert that. So I can't express enough that your tax advisor, again, is going to be critical to the assessment of when you can convert this. Now, what I would like to touch on is when you convert the property to a primary residence, before you can even qualify for the primary residence tax code, when you go to sell the property, you not only have to live in the property 2 years, but you must own it for 5 full years, for 5 years. So if I rent it for 2, I live in it for 2, and say at the end of year 4, I want to sell the property under my primary residence tax code, I do not get the exclusion because I have not owned it for a full 5 years. I would have to own it for 1 more year, then I will get the exclusion. There's another aspect. This is a 1-hour talk, so I'm not going to go into it, but when you're making these decisions, you need to look to see what else is going to be required once you convert it to your primary residence. Okay, so it can be done. Talk to your tax advisor as to the timing of that, of when that happens. Entities. One of the things about exchanges, and before I get into this specific question, it's important to understand that when you're doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. Okay? There are certain entity issues, like this question alludes to, is that there's an individual who is a member of an LLC, which, based on the question, I'm going to assume it's a partnership because there's 8 members in the LLC, unless they've chosen to be taxed as a corporation. And they want to go ahead and now sell that, the investment property sell, and they want to take their portion, their 1/8, and they want to go exchange it. Well, regrettably, you cannot exchange a partnership interest for real property in an exchange. The partnership, the LLC itself, can do an exchange, but the members that are in that LLC cannot go off on their separate ways. It is specifically excluded from 1031 treatment under 1031A2D. So you cannot exchange from a partnership interest, and nor can you exchange from fee into a partnership interest when it comes to an exchange, because the taxpayer that owns the property is the LLC. So again, this is why when you're dealing with in transactions, it's so important to engage the qualified intermediary, because our role is to take you through what the process is, ask you these kinds of questions as to what's the ownership, who's the taxpayer, how long have you owned it. And we go through all of this. We're going to tell you the rules to the road of the 1031, what to expect, what your timelines are, answer your specific questions, and or give you questions to turn and ask your tax advisor. And then to ask your tax advisor whether you need to do an exchange or not. So that's sort of the basics of the 1031. And when I say basic, I mean really basic. Okay. Now, so just to recap everything that we've gone through this afternoon. 1031, very powerful tool for building wealth in the real estate arena. So when you want to build your portfolio in real estate, this is a very, very powerful tool because, again, you get to defer the tax, use that money to go buy more property. The new tax laws have not affected 1031s in the sense, so we're still good for real property. So 1031s are continuing, and we're very happy for that. Always engage your CPA and a qualified intermediary, before you put the property on the market, while you've got the property listed, but definitely before the escrow closes on the sale of the property. And then be aware of when it starts, is that you have to have the qualified intermediary set up prior to the close of the escrow. The timeline does not start for the exchange until the escrow has closed. So it's not when you open up escrow, it's not when you listed the property, it's when the sale has completed. So that's the time frame. So that's the basics in the exchange process. So Joe, are you there?
Yes, I'm here. Thank you very much for that crash course in 1031 exchanges and the specific questions that our members have submitted. Just following up on that last one about the entities, we get this question all the time. Can I sell a single family home and 1031 into one of RealWealth Network's syndications like Reno or Park City, which is an LLC?
Well, okay, so if the Reno or the Park City is an LLC that's being treated as a partnership, the answer to that would be no. If that project is set up as a Delaware statutory trust, the answer would be yes.
Okay.
So it depends. It depends on what it is.
Yeah, it's a partnership, so it's
shares.
No. Shares is not a like-kind property.
No.
Okay.
No.
All right, let's go through some questions here. If one has done a 1031 exchange, say one home in California to two in another state, is the process the same when you exchange the two homes in the other state? So if you sell one house in California, get two somewhere else, and then down the road you want to sell those two and buy four somewhere else, is the process the same for the second transaction?
Yes, the process is the same. Nothing changes there. On the first transaction, you're selling one, you're buying two. So that's a multiple property purchase. So, so you're going to identify the two properties. You're going to close on the two properties. Now, the question becomes when you get ready to sell those two, are you selling those two together or are you selling them separately and buying something separate with each transaction? So this will require a little more conversation. So if they're consolidating, would you say going into four? So if I'm selling, for example, Phoenix, if I sell my property in Phoenix and I want to use that property to buy two properties, then I can sell that one anytime I want. It doesn't impact the other one that I'm still holding that I may want to sell at some future date. Okay, so I can sell the one, go in exchange, and then just continue down that particular road. However, if I were looking to do more consolidation as opposed to expansion, so I'm consolidating, then I could sell the two together to buy one, and that's possible in an exchange as well. The key for that type of situation is the timing of the closing for both of those properties, because if you're putting two properties in one exchange agreement, okay, the clock for the exchange is going to start at the closing of the first property. So you want to make sure that property two is going to close as close to the other one as possible, because that way you feel more comfortable. Because once that first property closes, the clock for the 45 days starts. So now you have to look to see what you're going to be identifying in the 45 days. And if you're looking at combining the two values and the one doesn't close, then now you've got a situation can you still buy the larger property without the other property if you can't get that second one to close? So I don't want to get too deep into it, but it can be done that way. It can also be done for consolidation, but timing is so critical.
Okay. Here's another one. If we have a property with the title in our family trust, when we purchase the replacement property, can we transfer the replacement property to an LLC right away?
Okay, well, the first question I would ask is, when you say family trust, is that trust revocable and disregarded for federal tax purposes, or is that trust irrevocable? So what type of trust is it? Because you can have a revocable trust that's disregarded for federal tax purposes, and that could be the husband and wife that are owners of the property. Everything's being reported on their personal Social Security number, let's just say. If it's an irrevocable trust, it's a different taxpayer. It's reporting its own income and expenses on its own tax return. Now, if you're going to use that and then you want to acquire the property in an LLC, what kind of LLC are we talking about? Are we talking about a single member LLC that's disregarded, or are we talking about creating a partnership? So it depends.
Okay.
If it's disregarded and disregarded on the buy side, then that's the same taxpayer. So the key to keep in mind is the same taxpayer selling must be the same taxpayer purchasing. So there's times where you can be holding title in a revocable living trust and possibly buy in your individual name or buy in an LLC that's disregarded, because it's all still reporting to the same tax ID number. But you can't change entities. So what I will find from time to time, folks may have holding title in a specific way. Say it's a husband and wife and they're in an LLC on the sale side, but they've chosen to be taxed as a partnership. Now they go to sell this property, they go to buy the replacement property, and they're buying 1-to-4s. It's very difficult, not impossible, but difficult to find a lender that will lend to a partnership. But you can't buy in your husband and wife name. You have to buy in the name of the partnership. So again, you have to look at the entities, make sure that when you set these things up, you also consider the exit strategies when you go to sell. Okay, so I know that was kind of a long answer to the question, but as long as it's the same taxpayer selling and the same taxpayer buying, if it's an LLC or trust, it's, you just have to watch who's my taxpayer.
Okay. Lots to consider. All right. Can I be in contract in the replacement property before my relinquished property has closed?
The answer to that is yes. And we'll see that where folks are putting their property on the market. It's a low inventory, so they don't feel that they're going to have a long time to wait to get a buyer for their property, and they want to sort of tie up the replacement property, and they go, well, I want to get under contract. The thing that's very, very important is when you're doing something of that nature, you want to make sure that your closing date for your purchase comes after the closing date of your sale. So you can't close on the purchase before you close on the sale and call that an exchange, unless you do something like a reverse exchange, and we won't get into that in this conversation. But you can't be on both properties at the same time. So if you are going to get under contract on the replacement property, make sure you feel very comfortable that you've either negotiated some contingencies in case you need them to stave off the closing of the replacement property to your sale closing, or you feel very comfortable that your sale is going to close in time. And that's just, pretty good planning. And we're seeing more and more of that right now, actually.
Okay, thank you. Chris wants to know, what happens if you move into a property you bought as part of a 1031 exchange? We kind of covered that.
Yeah, I did. Nothing. If the question is what happens, is there anything? You just stop reporting it as an investment property. So you're not reporting it that way anymore. So nothing really happens until you sell.
All right. Here's a question. How much does all this cost? Like, how does the fee schedule work? Like, let's say you 1031 one property in California for 4 properties somewhere else. How does
Okay. Excellent. Every qualified intermediary is going to have different pricing. We're all pretty close to each other. We're not that far apart. So I can speak to what our fee structure is. The 1031 is for, I would say, a vast majority of qualified intermediaries is a flat fee. Okay. Our fee for doing an exchange is $700 for the relinquished property, and then $300 for up to 3 purchases, and then sort of resets again if you're buying 4, 4, 5, or 6. So it's a flat fee. It's not based on the percentage. So whether your sale price is $7 million or $500,000, that's the fee. Our company does not charge for any wiring or anything like that. It's just a flat fee.
Okay, another entity question. Can you speak to the problems and benefits of 1031ing into a tenants in common with 1 or 2 co-owners?
Okay, well, it's available to do a 1031 because you have a tenant in common agreement set up. You own an undivided fractional interest. I would think that when you're going into a tenant in common agreement, you want to make sure that there actually is an agreement outlined. You have to see what the rules are about in the tenant in common. There's a revenue procedure 2002-22 that came out, which gave guidelines as to how these things should be structured from a perspective. From an ownership standpoint, you have to make sure that everybody feels comfortable with each other because now you're going to be operating with each other. Under the revenue procedure, you have to have unanimous approval for things. Again, that's under the revenue procedure. So if you're going into tenant in common with somebody, you're in, it can be done in an exchange. You can sell your interest and go away, go separate from someone else. That's one of the advantages. But you're going to look at what does the tenant in common agreement say? What are the rights, restrictions, all of that you have to take a look at, and that's where a good attorney will come in to analyze all of that.
Okay. How would a 1031 work if I hold title of my current property with 2 other people?
Okay, that depends on what entity are the 2 other, how are you holding title with the 2 other people? Is it tenants in common? Is it a partnership? What is it? So I can't really answer that question without knowing whether it's tenants in common or the other people that you're entitled with. It actually happens to be a partnership.
Well, let's assume it's
a partnership.
LLC.
Okay, if it's an LLC, then that means that the LLC has to be the entity doing the exchange. You cannot exchange your membership interest. In order for that to happen, you would have to come out of the partnership and take title as tenants in common. Now that begs the question as to how long in advance do you have to do something like that? And now we're going to get back to the tax advisor. If you have title in the LLC and it's taxed as a partnership, and my favorite 3 partners, Manny, Mo, and Jack, okay, all want to go their separate ways when they sell the property, then they're going to need some advanced planning about when they come out of this partnership to drop down, season the ownership of Manny, Mo, and Jack now, because remember, the LLC has been the one reporting the property, and the members have just been getting K-1s. But how long in advance do you do that? So there are some tax advisors that I have spoken with that say they won't touch it unless it's 2 years seasoned. Some are a little more aggressive and will say 1 year. Some even more aggressive and say, before they even get on a sale contract. So that's going to depend, because if you're ever audited, you have to be able to show the continuity that the new people on title can tack back that time of ownership to that of the LLC. So it's not a simple question. Well, it's a simple question. It's not a simple answer. So it just depends. You want to talk to your tax advisors if you're in this situation and you want to go your separate ways at the time of sale. You may start making plans now to do what you need to do to season the ownership of the members as tenants in common.
Okay. Well, we're coming up on the hour here, so we'll have to wrap this up. Thank you very much, Dino, for a very informative crash course in 1031 exchanges. For those on the call, if you're interested in learning more about what you heard, you can contact your investment counselor. The 3 of them are up there on the screen. There's Ben in Florida, Aristotle in LA, and myself in the Bay Area. If you don't have an investment counselor, you can schedule a strategy session at realwealthnetwork.com. Schedule strategy session. And this webinar will be posted. We covered a lot of material today, so if you want to absorb it more and watch it again, it'll be posted in the next few days under Learn, New, and Noteworthy on our website. So, okay, everyone, that concludes today's webinar. I hope you found it worthwhile. Thanks for attending, and enjoy the rest of your day. Goodbye.